The U.S. government has officially announced that the rate of inflation has fallen to 3.4% for July. On paper, that sounds like a victory for the American public. But the government's own jobs report reveals a conflict. While prices are rising at 3.4%, wages are only growing at a rate of 3.2%. When the cost of living climbs faster than pay, the result is a mathematical pay cut. Every month, the average worker is losing real-world purchasing power. That gap widens even further when looking at the Federal Reserve's M2 money supply, the actual amount of money moving through the economy, which expanded at a rate of 7.2% in 2026. A household attempting to cover a 7.2% expansion in the money supply with only 3.2% wage growth is taking a severe financial beating. If the official 3.4% inflation rate ignores the reality of these shrinking paychecks, we have to look at who actually benefits from maintaining such a low headline number. The U.S. government is currently managing a staggering $39.9 trillion in national debt. At the same time, 75 million Americans depend on Social Security benefits, placing the needs of retirees in direct competition with the interests of a heavily indebted Treasury. Retirees' COLA is calculated using inflation data from only July, August, and September. A low 3.4% July figure drags down the third quarter average. This creates a 2027 gap. Retirees get a 3% increase, while actual costs climb 7 to 8%. By reporting a lower official CPI during this critical window, the government avoids paying out billions of dollars, reducing expenses by underpaying retirees. The 3.4% figure was reached by leaning heavily on specific data points, such as a reported 2.9% drop in gasoline prices during July. The report also factored in a slight fraction of a percent decrease in food prices to help lower the overall average. The most significant impact came from shelter costs. Despite housing being a massive expense for most households, the government report claims shelter inflation rose by only 1.2%. This low figure is achieved because the government bypasses objective market data for rent and housing, relying instead on subjective surveys to estimate costs. The methodology of the July report relies on curated variables that produce a favorable headline, regardless of whether those figures reflect the broader economic experience. Beyond the national debt, these figures also serve the Federal Reserve as they prepare for their upcoming meeting on interest rates. Just 1 month ago, there was a 69% probability that the Fed would be forced to raise interest rates to combat high inflation. However, a subsequent bad jobs report showed the labor market was already losing ground, making a further rate hike extremely risky for the economy. Damaging the labor and stock markets just before midterm elections is a scenario that the political establishment is incentivized to avoid. The 3.4% CPI report provided the Federal Reserve with the exact justification they needed to pause, removing the immediate pressure to fight inflation with higher rates. Following the report, the odds of a September interest rate hike plummeted from 69% to 48% and finally dropped to 40.1%. Savvy investors use this dynamic to their advantage, profiting from the high likelihood that the Fed will now hold rates steady. The official CPI functions as a tool for institutional debt management and political preservation, providing the Federal Reserve with the statistical cover needed to navigate a weakening economy.